Start recording. So I will kick it off right at 11.
Perfect.
All right, hello and welcome to the Year Ahead in Global Soybeans. My name is Claire Weinzierl and I'm the Communications Manager at the Illinois Soybean Association. Please join me in thanking our corporate partner, HEDGEpoint, for sponsoring our webinar today. If you have questions during the webinar, please feel free to type them into the Q&A function at the bottom of your Zoom window, and we will answer those following the presentation. At the end of the webinar today, there will be a short 3-question survey to fill out that will pop up in your browser window, so please be sure to take a moment to fill that out. And one more note that today's webinar will be recorded in the event you would like to rewatch or share with your network. Without further ado, I'd like to introduce today's speaker, Christ Trant. Chris is a relationship manager for HEDGEpoint. He started his career in commodity markets as a summer intern for Daniels Trading. After graduating Miami University in Ohio with a degree in international business, he worked in various commercial roles with Bunge North America, Green Plains, and Informa Markit prior to HEDGEpoint. Chris lives and works in Chicago and enjoys history books, golf, and running. Today, Chris will be presenting the Year Ahead in Global Soybeans, an in-depth fundamentals presentation focused on upcoming US soybean harvest, South America planting, and the global supply and demand outlook. Please join me in welcoming Chris.
Claire, thank you, and welcome everyone. As Claire mentioned, I'm Christ Trant with HEDGEpoint Global Markets, a relationship manager specializing in agriculture based in Chicago. In previous career, I worked in Soybean Crush for a large commercial, so I'm really looking forward to today's topic, which is the year ahead in global soybeans. I'm going to start us off with a quick word about my organization. Then we'll get into the actual presentation. The goal of our presentation today is give the audience an overview of the key themes in the coming year and some insights on what to watch for in the coming weeks and months ahead. So kicking us off here. Who is HEDGEpoint? Who are we? We are a organization that originated from ED&F Man, which was the Structured Products Group. We are a global team that specializes in helping commodity risk managers to hedge their market risk. We help that by helping facilitate structured products strategies and access to capital markets. Our two owners of the HEDGEpoint organization are Albright Capital Markets, founded by Madeline Albright, and Dijon Capital, which is a company that specializes in financial technology. Our product suite of portfolio is full futures options and OTC products, as well as some more exotic derivatives as well, including calendar spread options. If at any point later after the presentation you'd like to connect with us, we'd welcome that opportunity. We have a product suite of ags, energies, FX, pretty much any risk management tool that you would need, we have access to. We are based around the globe and we are growing. We have a heavy presence in South America, particularly Brazil, but also a growing presence here in the United States, Europe, and abroad. So on to the presentation. So we're going to start with a quick overview on the current situation of the current soybean dynamic around the world. Then we're going to get into the specifics of the 4 major countries when it comes to global soybeans: Argentina, China, United States, and Brazil. At the conclusion, we'll kind of recap the common themes and then open it up for Q&A at the very end here. So where we are in terms of global markets with the world, bear with me here. There are 4 themes that really are hitting right now for the global balance sheets. One is that demand has outpaced supply the last 2 cycles. The second one is that the record production is expected to alleviate that tightness, but actually in all likelihood that will be met by record demand as well. The crushing margins are reliant on oil share, which has been a deviation from years past, and China demand continues to be the main topic of debate in terms of if the China demand is going to be a real and present going forward, or if we'll see that kind of fall to the wayside as China's hog herds expansion comes to a more of an equilibrium. So those are the four main topics to watch. Let's get into what's going on. The prospects for the crop year. We had 2 years of back-to-back deficits where new demand outpaced new supply. Okay, and that was deviation of years past where we saw that supply quickly outpaced demand increases. Not so the last 2 cycles. The USDA is forecasting that this coming crop year, we will see a increase in production that will basically offset that shift, and we'll see stocks growing. It's important to know that that shift is dependent upon record crops coming from Brazil, a rebound harvest in Argentina, and the 3rd largest soybean harvest in the United States. Should those 3 things happen, we will see a slight increase in terms of metric tons at the end of the year for the global soybean picture. But stocks to use is forecasted to remain constant at 17.1%. That's only above the drought years of 2011 to 2014, when soybeans were actually priced at $16 to $17, $18 a bushel, which is when I started my career in the soy crush industry. So calling for demand to be consistent and steady, mixed with the fact that they're saying that the supply will be comfortable based on record productions, it does beg the question, what if the record productions don't occur? Looking at the exporting countries of the world, the United States and Brazil are on fumes. They're sub 5% and have been for the last 2 years. In theory, Argentina is the country that has the most potential to have an alleviation for the supply and demand picture. However, we'll get into that, why actually that might be tighter than one may think. We're entering a critical phase for all 3. We have US harvest beginning in the coming weeks, which again is forecasted to be the 3rd largest on record. We have Argentine planting happening at the end of October, and we have Brazil planting happening at the end of September. So in the coming weeks, we're going to see essentially 90% of the global bean markets have key developments that are going to dictate prices for the coming year. Turn to Argentina first. While it's true that the carryover in years past has been more comfortable than Brazil and the United States, we have had 2 back-to-back disappointing crops in Argentina. That resulted in ending stocks being drawn. And where we are now at that 17.8%, although it's comfortable compared to Brazil and US sub 5% stocks to use, it's still on the tighter side of the last 5 years. The main takeaway from this is that oftentimes the Argentine farmer has been reluctant to part with their crops, and that the fact that they have the large stocks is not indicative of lack of demand, it's indicative of lack of supply being freed up. And that trend is likely to continue, perhaps more so this year than in years past. There's been an exodus of foreign reserves out of Argentina, which has further helped weaken the peso. Meaning that Argentine farmers are going to increasingly want to hold on to their dollar-denominated bushels rather than let them go at prices that they don't deem to be economical for them. In terms of where the Argentine farmer is and their appetite to sell, the chart on the left shows a absolute million metric tons of quantity. The right shows the percent of production. Looking at the purple line, they have sold less quantity than years past because of the political concern, because of the currency crisis, but also because they've grown less crops the last 2 cycles. But in terms of proportion, though, which is interesting, which is a chart here on the right, actually they've been selling about in the low end of the averages. So bushels still move at Argentina. It just takes a price that they have to live with. And with a rebound harvest, they may be more inclined to part way with bushels. So last 2 years, 1920 and 2021 had disappointing production figures in Argentina. they're calling for a rebound this year, which again, that planting will start at the end of October. Interestingly enough, most of this rebound will be led by both a decent increase in yield, but more importantly, 800,000 new hectare-acres of land being dedicated to soybean harvesting in Argentina. This question begs, if they don't have that production again, will they be as willing to part ways with bushels? Which the answer is probably not. If the crop disappoints and the US dollar prices continue to increase, more than likely it'll be difficult to pry bushels out of Argentine farmer hands. And we may see actually the stocks to use get bigger, which will not help the global supply and demand picture. Speaking of demand, you can't mention global soybeans without China. China consumes 30% of the global soybeans every year. Most of this demand is centered on their hog herd. Pork is the main staple protein in China. It has always been, and although there has been some shifts recently after ASF, it'll remain the dominant protein in China for the foreseeable future. ASF wiped out essentially 1/3 of their hog herd. That also caused a shift over to beef and chicken, and pork production and pork consumption in China fell throughout 2019 into 20, and certainly COVID did not help that dynamic at all. However, since then, the hog herd has rebounded. We are now back to actually above ASF levels. And although prices have certainly fallen recently, they are still above ASF levels. All this expansion in the hog herd has led to a surge in demand for soybean meal to feed the growing herd. The last 20 years, China has only had 1 year where they consumed less soybean meal than years past. And that was in 2018-19 when they had ASF and a trade war. Since then, the recovery has been progressively higher. And this has been the underlying support and rationale for China to import so many soybeans from Brazil and the United States, and this trend looks likely to continue. Point to make is that just because that China has caught up to where their hog herd was pre-ASF does not mean they're done adding to it. In fact, the last 2 years, while China did lose and replace 1/3 of their hog population, they added 20 million people to their population. So they had 20 million more mouths to feed. And that population trend growth is set to continue going forward. So the amount of hogs are increasing, the amount of people to feed are increasing. And we have seen a sharp increase in total meat production in 2020. And that we believe that figure is going to continue to rebound going forward as global recovery takes place and as the Chinese population continues to expand. In terms of what the Chinese expanding population is consuming, we did see actually an interesting shift occur during the trade war and during ASF. Pork lost a good deal of its overall market share in terms of consumption. We saw beef and chicken increase as a result. The belief that it was easier to find, the belief that it was safer, healthier. Now that's behind essentially the Chinese consumer, it's likely that we'll see pork increase in terms of the percent of the overall meat production and meat consumption. However, interesting to note that between 2021 and 2018, beef consumption rose 28%, chicken rose 25%. And while on the chart on the right, you can see that the projections going forward for beef and chicken are less than 2020 and 2021, they're still higher than pre-ASF, 2018, 2017. This implies that a lot of the demand shift from the Chinese consumer might be sticky, and the actual demand for proteins of all stripes, pork, beef, and chicken, will likely continue to be very supportive going forward. Despite the strong meat sector and demand growth, stocks have been rising in China. So despite the fact they're using more soybean meal, we've also seen the soybean stocks also increase. And this kind of presents a bit of a paradox of, on one hand, China's consuming more soybeans, but they're stockpiling more soybeans as well, which leads to some to debate what the actual origin of the demand might be. Meanwhile, they actually are projected to increase their imports next year to 101 million metric tons. despite the fact that margins have not been great in soy. So again, you have a paradox of large soybean meal use, you have large growing soybean stocks, and record imports as well. So all this kind of equals to a point where you have to look at what's actually going on with the Chinese hog herd. Slaughter has picked up in China as the margins in hogs have been falling in the past few months. This is probably a temporary phenomenon. In all likelihood that we'll see slaughter kind of stabilize as the Chinese government's trying to encourage a large hog herd to basically feed its growing population. Meanwhile, despite the fluctuations in the slaughter, stocks at the ports have remained steady, implying that despite actual short-term fluctuations in the Chinese hog herd, the Chinese are still importing a steady amount regardless of that. Turning the crush margins, they have been negative, and this is a theme that we will talk about for Brazil and United States. Crush margins started the year in China at record highs. Since then, a boom bust cycle has occurred in hogs. Hog prices have fallen. Chinese crush margins have fallen as a result. However, they're being led higher by soybean oil demand. Traditionally, this is something that is opposite of how most bull markets go in soybeans. Traditionally, the soybean meal prices lead the way higher and oil share drops. It's the opposite this year, right? Oil share is an increasingly dominant deciding factor when it comes to run rates. And that's true of Brazil. That's true of China. That's true of the United States as well. The question is, why is there so much demand for soybean oil, and why is it dictating so much of the margin? The world's veg oil supply and demand has been having reductions the last few years. There have been supply issues with Canadian canola, with Malaysian palm oil, and meanwhile, demand for veg oils has increased. We've seen a stocks to use get tighter in the last few years, and we've seen stocks continue to get lower and lower as well. All this demand for veg oils is leading the soy crush higher, and that's true of both palm, canola, and sun. The net result is we have expensive inputs with high Chinese soybean prices. And then the outputs, you have meal, which has come down from the beginning of the year when there was the record. Meal is still higher than the last 5 years, but as far as percent of the margin goes, it's less, and it's not enough to offset the high cost in soybeans. Meanwhile, soybean oil is at all-time highs. So it remains to be seen how long this dynamic will occur. At some point, crush for oil will have to lead to an overproduction of meal. And while the Chinese hog herd certainly is expanding, the question becomes, will the Chinese hog herd be large enough to clear the meal stocks? And if not, at what price do those stocks get cleared? Despite the fact that margins have been less than attractive in China, they're still importing a large amount of soybeans. The USDA is forecasting a 97 million metric ton import figure for China from all destinations. At hEDGEpoint, we actually think that figure is closer to 100. Either way, next year they're calling for a record 101 million metric tons of imports. So in terms of their appetite for soybeans, it appears to have not stopped. But again, the key kind of takeaways is that they're importing soybeans for crush, which is based on soybean oil demand. And meanwhile, their stocks are also increasing as well, despite the fact that the hog herd has enough consumption to certainly have a need for soybean meal. The question becomes, as oil share leads higher, will the soybean meal that is unpurchased weigh on prices going forward? Turning to Brazil, we're going to first talk about the supply, then we're getting into the demand. We'll do the same thing for the United States as well. For supply, like any other unknowns, there's basically two main ones, right? The area and then the yield, and Brazil is no exception. We believe that there might be some marginal shifting of hectare acres in the south of Brazil from soybeans to corn. Not that we would see switching take place of already decided hectare acres, but there is some marginal ground down in that part of the country that will shift year to year based on local prices and local basis. will that be enough to offset what's going to be a record crop in record area? The answer is probably not, but it's certainly a nuance to keep in mind, because we have seen that the price for corn in Brazil has absolutely surged. The Brazil safrinha crop disappointed. There was drought issues earlier in the year, and there was actually a frost in the south about a month ago that really increased the corn price in Brazil. It's up 125% year to date. What that implies is that there's a good chance that farmers will respond to that and shift over from deciding to plant beans and deciding to plant corn instead. However, it's going to be marginal amounts. We don't think it's going to amount to being able to offset what's going to be a record crop, but there might be some marginal acreage, 2% of Paraná, 2% of Passo Fundo that will be impacted by this. Either way, looking at the hectare acres expectation for growth, in all likelihood, we're going to have a larger figure than last year, which already was a record. So we've had essentially a ladder starting in 2007, where every year the amount of land in Brazil used to grow soybeans has increased. Looking at the last 20 years, it's an impressive figure that area has doubled in 20 years in Brazil since 2000, just illustrating the absolute large demand for Brazil soybeans and the economics behind their export-driven sector. What is more of a variable, at least in our opinion, is what yield might look like. While we think that the acreage in Brazil will be very marginal, less than 2% impact in only some regions, we do think that there is a chance that the soybean yield will be affected by La Nina. Should that effect take place, the spread between trendline and optimistic and pessimistic forecasts is enough that it could certainly move the balance sheet. However, it's really a wild card. You might recall that last year, La Nina occurred in Brazil, and there's actually a record crop. So La Nina doesn't necessarily mean that the crop will fail, but it does increase the likelihood that an extreme weather event might take place. And again, the crop goes in the ground at the end of next month. So there's plenty of time for this to develop. But that being said, from a supply perspective in Brazil, we're looking at a scenario that's going to be record crop, 140 million metric tons. That is assuming that we get trendline yield and assuming that the area does not shift too dramatically to corn in some parts of the country. Interesting to note that domestic crush has been an increasingly larger figure of demand in Brazil. Brazil is traditionally an export-driven soybean supply and demand, where soybean exports dramatically outweigh the crush ever since 2014 drought years when demand really increased. Since then, we've seen an explosion in soybean export demand. However, we have seen the crush sector in Brazil growing substantially. The crush in Brazil actually in the last 20 years is up 20%, versus 10 years ago, excuse me. But primarily, Brazil is an export-driven soybean economy, and we expect to have record exports for the coming year in 2020, 2021. As of this year, though, after a very impressive March, April, and May, we have seen the window in Brazil start to close. They actually exported less than last year, year to date. What this implies is that they might actually have trouble hitting their export figure for this year. Most of the demand is China, but it is interesting to note that a growing portion of the Brazil soybean exports is coming from non-China sources. But overall, it's still expected to be a very large export for this year. We just have in mind that we might see things slow down as their window collapses. Where we are now, Brazil actually landed in China is among the more expensive soybeans. Right now, Argentina is technically the cheapest, but for reasons why we discussed earlier, why the Argentine farmer is reluctant to part ways with bushels, there aren't many soybeans getting out of Argentina into China. In fact, Argentina exports less than 5% of their soybean crop in any given year. Most of the Argentina soybeans go to domestic crush, and in turn that goes to export for meal, exports for oil. The United States is about to start their harvest, which implies that we'll see FOB ratios get back to more economic levels for the United States, and we'll start to see the United States soybeans be more attractive in terms of landed in China values. Crush margins in Brazil, which again, Brazil is primarily characterized by exports, but they have a growing crush sector. Much like China, it has had started the year with very, very healthy prices. Since then, it's fallen to about break even, although it has rebounded slightly. And most of the crush decision, again, is being made by the oil share, right? Demand for biodiesel, demand for renewable fuels is really fueling the crush considerations. As far as crushing goes, interesting to note here that the crusher to begin the year in Brazil actually purchased, at the time was a record amount of forward purchases. In years past, they decided to operate in a very kind of hand-to-mouth function. They would basically buy their needs as they needed them. And then the last 2 years, they saw the massive export demand that hit the Brazil market, and they decided to make sure they secured their needs in advance. So what this essentially is telling us is that the Brazil crusher secured their yearly needs already, and that future crush will be more or less impacted only by what's already been purchased and what's going to already on hand and what's going to show up as to arrive. So we'll probably see not many surprises out of the Brazilian crush figures going forward. But still important to note that crush as a monthly basis is still actually in the higher end of years past, despite the fact that margins are not very good. Right now in Brazil domestically, it's also important to note that we're seeing that stocks are starting their seasonal decline, meaning that as the Brazil beans have left the country for exports, and as the crushers are accumulating bushels, there has been a drop in available stocks. As a percent of demand, interesting to note that even as they fall in absolute quantity, as a percent of demand is close to a 10-year low, meaning that despite the fact that margins are not incredible in Brazil, they're just about break even, and despite the fact that their export windows already seemingly has passed, as a percent of demand of what's available, it is very, very, very tight. So even the fact that you would think on any other given year, we'd see some relief to the terms of the soy prices, that's not the case. That's how hot record demand is, both for biodiesel and for exports around the world. So for new crop, which is going to, again, be a record production, we're calling for record demand. We're calling for exports of 86 million metric tons. And we're calling for a crush figure of 47 million metric tons. Odds are that the exports demand to China will lead the way forward, but we expect that on the crush side, it to be steady, if not slightly higher year over year. Turning to the FX equation, the real is very weak, and that's been supportive of Chinese exports. It's important to note that there's actually an election coming up in Brazil, October 2022, I believe, and both candidates are populists, meaning that government spending and supportive, economic climate behind that will probably be supportive for a weak reals, which will help them have higher export prices versus the United States. In terms of FOB pricing, in terms of what they're getting for their soybeans, it's been up 125% since 2016 as the real has depreciated. In dollar terms, only up about 70%, meaning that even as the real becomes weaker to the dollar, which helps the Chinese importer create a margin, it also helps the Brazil farmer actually capture more of their margin too. So it's a win-win for both the buyers and the sellers with the weak reals, and that's likely to continue going forward. Also, from a crush perspective in Brazil, we are expecting that the biofuel demand will continue going forward. Biofuel demand has been basically set to increase 1% every year going forward, which is supportive. They did have a 2021 mandate get temporarily reduced. They had very low carry-in from years past. They had a very tight domestic situation, and the coronavirus also may have impacted their political calculus. But we do expect that the demands for biofuels will continue going forward, which will provide a supportive environment for crush in Brazil. On the meat side of the equation, a little different story. So soybean meal was primarily used in Brazil to feed the growing animal herd. That herd has increased substantially over the past 20 years, but it's appearing to be stagnant for the time being. Interesting to note that the decrease in year-over-year projections from 2021 to 2022, that was led by export. So Brazil is set to export less protein than the last couple of years. Why is that? Well, because the Chinese hog herd has expanded. There's less demand for Brazil meat exports as a result. So we'll probably see a decrease in the actual exports of meat. We'll see a slight increase in consumption, but overall, we expect that Brazilian meat to stop their growth going forward. But that's still enough support of supporting meal demand that it'll impact crush decisions to be made. So despite the fact that soybean oil is leading that margin higher, there's still enough animals in country to clear meal. The question, like China, becomes at what point does the soybean oil share dictate too much of crush, and when will soybean meal be overproduced? If that occurs, how do you find enough animals to clear that meal, and at what price becomes the question. Putting it all together, we're expecting a record crop in Brazil to be met with record demand. It's important to note that for all these situations, for Argentina, for Brazil, for China, having one domino get out of place, for example, let's say the yield in Brazil declines first this year, and you don't get that 140 figure, let's say it's a 136 figure. Global supply and demand situation is going to be very reactive to that. Looking at Brazil itself, we had stock draws, below 5% over the last 3 crop cycles. This year, they're pricing in a record crop, right? By that, I mean USDA. A record crop's only going to increase stocks to use by about 3%, right? Even a small variation from that record, even a 5 million metric ton variation from that record, which is a percentile, would not be impossible or even unheard of, that would take stocks to use back down to sub 5%, all things being equal. So the demand going forward for Brazil looks very, very good, both in terms of rising exports and increased domestic use. But again, if there is a production hiccup, all of a sudden the record crop becomes not a record, becomes very good, but the price, the pain of soybeans would be higher than from that point. So turning to the United States. So we have harvest beginning here shortly. I'm sure many of you on this call have some good insights on that. From where we sit as HEDGEpoint, the crop got in the ground early, very fast pace during the summer. The blooming and pod setting happened at about the average of the last 5 years. So overall, the crop looked on average good. There are parts of the country that have had issues, which we'll cover shortly. But by and large, they're calling for the 3rd largest soybean crop on record, with again harvest set to begin here in middle to late September. Regarding the crop conditions in the United States for soybeans, it's really the tale of 2 parts of the country. In the Western United States, you've had severe drought and severe heat that not only has bled into the Northern Plains, but also into Canada as well, into their wheat and canola fields. But that area of the country, North Dakota, South Dakota, Minnesota, Wisconsin, they've had severe droughts and a severe impact on their good to excellent deviation. Between the Dakotas, Minnesota, and Iowa, so 30% of the overall United States soybean production. Iowa alone is the 2nd largest producer of soybeans. Their good to excellent is down 15%. North Dakota's good to excellent is down an amazing 57%. Minnesota is down nearly 50%. So all this essentially begs the question is, will the deficits in the western part of the United States drag down overall yield nationally to a level that impacts overall production where we don't get the third record crop? Will the yields in Ohio, Indiana, and Michigan, for example, offset the poor conditions in the West? Last WASDE, the USDA did make a shift based on several good to excellent reduction crop progress reports. They cut yields 0.8 bushels. Still though, as far as the actual production figure being forecasted, the third largest ever, only behind 2017, 18, and 18 and 19. And again, we have prices that are more conducive of the drought years than they are from that time period. But that only illustrates how much demand there is for soybeans globally. So turning to the remaining portion of August before harvest begins, where we are in terms of Iowa, Minnesota, and the Dakotas in terms of precipitation, we're actually behind the average in terms of years past what we've already received. However, the forecasts, according to our analyst team, indicate that we will see beneficial rains here over the coming days over the Dakotas, Minnesota, and Iowa. Should we get that, we think that the actual damage that people are being concerned about might be slightly alleviated. Okay, it won't be enough to offset all of the damage done to the yield, but it might be enough to marginally shift some bushels around in terms of the actual final yield. So at HEDGEpoint, actually, we're forecasting a yield of 50.2 versus the USDA's 50. So net still very, very close. It's very close to the actual USDA projection as well. Factoring that all in, we have a scenario where the third largest crop occurs, and if the beneficial rains occur, we'd be in a situation where we don't see much need to change the USDA's current projections. In fact, we're within 20 million bushels where the USDA is at. Where we do have some differences is demand. So unlike Brazil, the demand situation in the United States is closer to 50-50 in terms of domestic crush versus exports. In Brazil, it's closer to 60-40, 70-30 in some years in terms of exports versus domestic crush. We've had 2 years of back-to-back sub 5% stocks to use growth. Sorry, stocks to use percentile. We've seen exports this year, 2020, 2021, we're actually at a record. We do think that's going to decline in the coming crop year. As far as crush goes, actually, we're projecting a record crush for the coming year. So while still very tight, assuming there is the third largest crop coming, we may be able to see solid demand as well. But we might see some rationing as a result. Turning to exports, this year was a record year for US exports. We're on pace to hit that, and so far we're off to a good start for 21-22. The orange line on the right shows new crop US soybean exports already on the books. It's behind last year. China is approaching a very critical window. They may be coming to the market to purchase new crop US soybeans. They have not done that substantially as of yet. There's a debate going on if China is comfortable waiting for Brazil's record crop to come online before they will begin purchasing substantial US ag goods. That's part of the debate we mentioned earlier in the presentation. However, there's also a good chance they do come to the table and purchase both large US and Brazil figures as well. Now, this chart basically details what our exports have looked like to China in relation to phase one. And the reason why we're bringing up phase one, despite the fact that China is behind their commitments by 18%, China has been a large buyer of US agricultural products since phase one was signed. And there was many people in this industry who are very skeptical of their willingness and commitment to actually purchase what they have. In terms of where we are January to July, which is based on the current data we have, China has actually imported about 100% more quantity of beans year over year, right? So they've doubled basically they've doubled their imports of our beans January to July, right? But in terms of the dollar amount paid, it's more than doubled. It's nearly tripled, right? So China's buying more US soy from the United States, and they're paying more money for it too. And that's kind of counterintuitive given where Brazil's at, given the currency advantages with a weak real, right? But important to note that the China phase one deal, it's a dollar amount figure, okay? It's not quantity. So in some paradox, you could argue that China's political calculus might be buying expensive soybeans is good because it helps us hit our target. So it'll be a fascinating dynamic to watch. Will the Chinese continue purchasing high-priced US soybeans to meet a political goal? FX will be a critical factor in this. We have seen the dollar start to stabilize recently, which may offset some of the US export competitiveness going forward. And if anything, I'd see the dollar start to slowly rally as well. Meanwhile, compare that to the Brazil reals. And the fact is that the currency arbitrage is very attractive, right? Which is another point to make as well. Well, China wait to buy US soybeans until they can buy cheap Brazilian beans with a cheap reals. And that is going to be a critical factor to watch going forward. Also, the freight rates as well. So freight rates to China are sky high from any origin, but the US is set to be competitive starting in October, right? So month one is August, month two is September, month three is October. So come October, after our soybeans come online, we will likely see the US be able to actually be the competitor, be competitive in terms of Chinese soybean imports in terms of price. I'd add too that this is going on in a dynamic where US Crush, while still better than Brazil and China Crush, is weaker compared to years past, and again has been increasingly dominated by soybean oil. Lower board crush has kept us below last year's record NOPA levels. It seemed that a year ago, 2 years ago, every NOPA report was a record for May, a record for March, record for August. And now we've been below those levels because of the weaker margins. That said, as we mentioned before, that soybean oil continues to be the main driver of crush in the United States, as is Brazil and as is China. What is interesting to note, though, is that the forward percentage of oil is set to actually decrease slightly, but overall it's still going to be a dynamic where the oil share is going to be the dominant picture going forward. These 10-year highs, as I mentioned, or 10-year highs for the soybean crushing are unprecedented, and it remains to be seen how long a soybean oil crush environment will last for. Historically, it's not long, but there are political considerations to keep in mind. Most of the demand for US soybean oil is related to the massive growth in biofuels, right? This has been a political mandate. It's also been a corporate governance as well. It's both a federal level with renewable fuels and also with many states entering their own schemes and their own mandates as well. As far as soybean oil use in food, we actually have seen that decrease over the last few years as more competition for food use oil increases, like from canola oil. And we've seen most of the demand for soybean oil come from industrial use, and that trend is set to continue. The EPA has basically kicked off the year with some bullish news in terms of future mandates. Since then, it has fallen by the wayside as the EPA has asked to keep things steady for the time being. So while prices have come down, they have stabilized. And right now the industry is waiting for direction from the government in terms of which way and how much mandates will increase in years to come. But most believe that mandates will continue to increase regardless. Biodiesel is at where we are now. Actually, it's interesting. We actually have produced a record amount of biodiesel in this country. And right now, the mandate currently is not enacted for this year because of the COVID rules. But margins are still telling producers to blend. So that's a critical function to make. Despite the fact that the industry has uncertainty regarding the mandates, the margin's still telling them to blend. So likely we're going to see that while oil will continue to lead forward, you'll need to see how long that will last, right? So as soybean meal piles up, that demand has to be cleared. Sorry, that supply has to be cleared by some demand. In terms of the United States meat market, the American consumer has consumed more and more meat over the last 20 years. We are seeing that trend starting to plateau. We did see a slight increase in exports as well, thanks to ASF. But again, much like Brazil, the fact is that the US is exporting less meat because there's less demand for it because of the Chinese hog recovery. So meal is probably going to be very plentiful as crush margins continue to be relied on by soybean oil. And it'll be up to the herd to clear that meal. And if not, it remains to be seen what price that meal will clear. And at some point, it will have to. Overall, looking at the U.S. supply and demand sheet, record tightness is going to probably continue. There's only 1 year we had less stocks to use, and that was 2013, 2014, right, when bean prices were $16 to $18. For the coming year, we're actually looking at probably what's going to be a record domestic consumption led by increased biofuel demand and a decrease in exports. That decrease in exports is factoring in a record Brazil crop, a record Brazil export program, and a continued weak Brazil currency versus the United States. What begs the question is if the Brazil crop disappoints to an extent, and if the demand for soybeans around the world has to find a new origin, we could potentially see that this figure gets revised higher. Putting it all together, balance sheet of sub 5% appears to be the new normal in the United States. It will take progressively larger crops or a decrease in global demand to change this dynamic. That being said, it's likely that crush will continue to be supportive going forward as biodiesel demand is not going away, even if the government EPA doesn't set their mandates. Local, state, government, social movements will impact corporations to increasingly blend more biodiesel. And export demand will likely continue to be strong given the Chinese hog herd expansion. But again, very, very tight stocks to use. So where we are now in terms of current pricing, this essentially shows that square is our last price. So where we are now in terms of years past WASD, we're probably fair, right? We're probably fair in that $12 to $13 range. I would add that sub 5% is when we get into the scenario where we do get into the more $15, $16 beans, and we're not very far from that. So kind of a message I want to leave with is, the current prices are factoring in record demand for global soybeans and also record production. If we don't see a record crop in Brazil, if we don't see a rebound harvest in Argentina, and if we don't see a third largest harvest in the United States, in all likelihood, demand will continue to stay constant, right? Because of the biofuel demand, because of the veg oil demand, and because of the Chinese hog herd. So demand's probably going to stay constant. And if we don't get these record crops that are forecasted to come in the coming year, I believe that the current price is not reflective of where we need to be for that dynamic. What to watch, and before we wrap up here, Brazil weather, La Nina impacting what could be Brazil record production. Biofuel mandates direction from the government. US yields, which of course are getting more clarity on as private tours occur. But again, that 50-ish US soybean yield figure is probably fair. And looks like we're going to finish the month with positive rainfalls in the problem areas, but remains to be seen. In September, we'll have more clarity on that with the latest WASD, and then of course, China Crush. Will the Chinese margins improve? Will that lead to the hog herd continue to expand? And will that expansion eat through the soybean meal stock? So the wrap up, thank you all. Claire, do you have any questions?
All right, thank you so much for that informative presentation, Chris. We're now going to begin taking questions from the audience. So if you have a question, please type it into the Q&A function at the bottom of your screen, and we'll try to get through as many as we can. We do have a few here. The first question, Chris, is do you think summer corn has the chance to take more acres than estimated from soybeans in Brazil?
That's a good question. I'm going to go back to that slide. I think marginally it might have impact in parts of the South, particularly in the regions of Brazil that experienced the safrinha crop failures. So that's Passo Fundo, that's Paraná. But as far as where those are in terms of relation to the overall soybean production, it's more marginal, right? So we could see a small 2% shift in Paraná, maybe 2% shift in other parts of the South, but according to our analysts, it won't amount more to 1 million metric tons, 2 million metric tons. And even if that occurs, in all likelihood, we're still going to have a larger, even our most pessimistic view in terms of actual production will be higher than last year. So either way, we're calling for a record area use in Brazil, despite the fact that there might be some marginal shift to corn thanks to the high domestic Brazil safrinha prices.
Okay, thank you. Next question. How do you see the impact of La Nina to the Brazilian crop in case it occurs?
Really good question. So La Nina really can be a wild card. I mentioned how last year, actually, there was a La Nina event in Brazil, and it was a record figure, which is certainly a fascinating thing to keep in mind. That said, sometimes we're not lucky twice. So if there is a La Nina event, what I can say is that the global balance sheet needs to have a record Brazil crop. And it won't take a crop failure to cause prices to go much higher. It'll only take a slight reduction. So if the crop comes in, say 5% lower than a record, that's not a crop failure, but that would be very impactful to the global balance sheet. I don't want to say catastrophic, but the world can't afford to have that. So I would say that the chances of La Nina impacting yield, I'd say it's going to have a impact in the sense that even the rumor of it will cause prices to move. As far as the actual final impact remains to be seen. The crop's not even in the ground yet, but just the rumor of La Nina kind of lurking its head will be enough to move prices. And if it does occur, it won't take much really to have a large price event to correlate with that.
Okay, we just had another question come in. How do you see the impact of La Nina in Argentina? Is it different than in Brazil?
Another good question as well. Go back to Argentina. The Argentina crop that they're calling for is a rebound. They've had 2 years of disappointing crops. The same events, the same impact will happen with La Nina in Argentina. The Argentina crop comes actually out of the ground actually a little later than Brazil. Comes out in March for Brazil. Harvest starts in kind of late Jan. So it does have another month difference. That being said, though, the main fear with La Nina is that there's enough soybeans in Argentina with stocks to use that if the Argentina crop does have an issue, in theory, there's enough slack domestically to make up for that. That's not the case in Brazil. Brazil's already at sub 5% use. Argentina, in theory, can afford that for their balance sheet. So if production is decreased in Argentina, in all likelihood, that's going to cause prices to increase, and then it'll be the domestic market's job to find a price for the Argentina farmer will move bushels, right? Which they'll be reluctant to do. In my opinion, the actual La Nina impact to Argentina won't be felt as much in terms of their own crop. It'll be felt in their reluctance to sell soybeans if prices do rally because a La Nina event occurs in Brazil.
Okay. Next question. In your opinion, what is the biggest thing to keep an eye on as US farmers head into harvest, and why?
It's not a good question. Heading into harvest, I would say pay attention to the yields out of Minnesota, Iowa, and the Dakotas. Our analysts are hopeful that the rains will occur in a timely manner in that part of the country. And if that happens, we do think we'll see some yield relief, right? It won't be enough to save the day. Anecdotally, we have some customers in that region who actually have had some concerns about some of their producers have inquired on some of their forward sales. What would it cost to get out of some of their forward sales because they're concerned about their own yields? So I'd say if you're a farmer in the Eastern grain belt in Indiana and Minnesota, Indiana, Michigan, Ohio, your yields are looking good, but pay attention to what's going on out west because that's really going to dictate the market. Remember, Iowa, even though they're only down 15% in terms of good to excellent from the 5-year average, they do grow the second largest amount of soybeans in the United States. So if yields do surprise to the downside in the coming weeks ahead, that's going to be a sign the market's currently not priced correctly. But if yields come in at, about trend line or what they're expecting, then odds are I think that the third largest crop will occur. But is it any sort of indication that the crop might come in lower than expected? The canary in the coal mine will be that part of the country. It'll be the Dakotas, Minnesota, and Iowa. So pay attention to that.
Okay, thank you. What is your view on Brazilian soybean exports and how will they compete with the US?
Another good question. So Brazil exports for the coming year, we're actually setting that as the record. So 84 million metric tons versus 83, right? And the record was set back in 2017-18 during the trade war when essentially shipments from the United States ground to a halt, right? So there's been tremendous demand for Brazilian soybeans since then. It hasn't really paused. So we believe that exports are going to be a record, right? It's going to be a record crop, and also the currency makes it very attractive for large purchases out of Brazil. The question will become is if the record crop doesn't occur, right? If it goes from a 140 to 135. What gets eaten into first? Will it be domestic crush or will it be exports? And to that, I'd say what might shift some demands somewhere else, perhaps the United States, is the crusher, the domestic buyer, Brazil soybeans. They showed us this year that they are going to secure their needs. They'll be very aggressive with it, right? Which has been a deviation of years past. I read in that they've learned their lesson, right? They've realized they have to secure their needs. They can't live hand to mouth. So if there's any reduction in potential for production, I would not be surprised if we see the industry, domestic industry, pay up for bushels. That will probably shift some export demand somewhere else.
Okay, here's another question. I think you may have touched on it a little bit, but will oil and protein yield have any impact to the market? And is that a factor between the US, Brazil, and Argentina?
It's a good sum up question. The answer is yes. So both globally right now, the price for veg oils are sky high. That has led to crush margin decisions being made based on oil share instead of soybean meal share. Traditionally, soybean meal is what dictates crush rates. And usually, basically, crush rates for the people out there might not kind of know, they're basically dictated upon what percent of their overall dollar amount you get to crush the beans comes from what source, right? So usually you got about a third of your revenue from soybean oil, right? So 70% of your decision is based upon meal, okay? Now it's 60-40, okay, and it's growing. So most of the decisions being made, both in Brazil, both the United States and China, are being made based upon increasing oil share demand, okay? And that oil share is because both biodiesel demand, both green energy, both world consumption of biofuels has been increasing. And the question is, as crush continues and as they produce more and more meal that wasn't intended to be produced, that meal has to clear, right? So it's possible we see meal prices lagging, and the question becomes, how does that meal disappear and at what price?
Great, thank you. All right, that's all the time we have for questions today. I want to take a moment to thank Chris for his presentation, and thank you to our corporate partner hEDGEpoint for sponsoring today's webinar. Don't forget to complete the short 3-question survey at the conclusion of the webinar, and thank you all for attending. We hope you have a great rest of your day. Thank you.
Thank you, everybody. Appreciate it.